How can you prepare yourself for all the uncertainty out there and changing market conditions? Hello, everyone. I'm Patrick Fross with Fross & Fross Wealth Management. So, what can we do? What can you do to stay prepared and to tune out all of this noise and really look beyond the noise, beyond the chaos, beyond the headlines, and really make good, sound investment decisions based on the facts? Well, one of the things that we wanted to share with you is the power of diversification. This chart shows diversification for the long run. The gray bar is an all-equity portfolio. The green bar is a 60-40 stock-to-bond portfolio. And we see if you're one of those that prefers having more days of positive returns, we see that in 1 day, 1 week, 1 month, 1 year, 3 years, 5 years, and 10 years, a 60-40 portfolio versus an all-equity portfolio on average has more positive returns, frequency of positive returns across all those time frames. Now, in all fairness, if you're in an all-equity portfolio, your returns over the long term potentially could be higher, but you're going to have more negative days, and it's going to be much more of a roller coaster ride. So if you're looking for more stability, there's things that we can do. This is a very simplistic chart. It doesn't go into great detail. There's things that we do behind the scenes as you peel back the curtain. Not just 60-40, but different asset classes within those equities, different asset classes within those fixed income sleeves. So there's things that we do to even more diversify the portfolio and protect our clients. Now, we don't have a crystal ball. We can't tell you what's going to happen in the market tomorrow, much less next year. But what we do know is we do have history. And history is a very good guide. I know history does not always prove to be a perfect indicator of future results. Because we don't have a crystal ball, we use math. We use probabilities and statistics. And this chart is very interesting because it shows us focusing on the middle of that chart there. In any 12-month rolling period, you have about a 77% chance of positive returns. But on the flip side, that means that 23% of the time the market is negative. So for those that take income from their portfolio, we have to be very careful. We can't have all of your assets in equities fully invested because there's too much of a chance, 23 at least to us as financial planners, that's too much of a chance of negativity or what we call sequence of return risk. We don't want to have to sell assets when the market's down. So we mitigate that risk by using lower risk assets for short-term needs. And we'll show that to you in a moment and illustrate how that works. But as we move forward in time frames, 5-year, 93%, 10-year, 97.4% of the time, the market is positive. And that's really, really good math. If you could go to Vegas and win 97% of the time, you'd probably go. So I think long-term money, this really illustrates why long-term money should be more aggressive. And this also illustrates why we use what's called the buckets of money approach. So this is how we mitigate that sequence of return risk. Now money you need in the first 12 months should be more conservative. We're talking about cash, money markets, CDs. We can't tolerate a penny of loss in your 1-year short-term money. But as we get to the soon money or money that's out 2, 3, 4 years, that's an inflation hedge. Short-term bonds, structured notes, things that we can do to beat inflation but still mitigate that volatility and bring down the chance that you're going to lose money in that bucket. However, later buckets, money that's long-term growth money, should be more aggressively allocated. Now, this is a very simplistic approach. It's actually much more sophisticated than this. Typically, we use 5 buckets with different asset classes within the buckets, but this is a nice generalization.